Welcome to the first course. In that course, we will learn how UAE tax savings actually work. So, who gets to tax you? For example, your company has a home. The country that is your company's home can tax its profits. Now let's see what the rule says. A company is taxed worldwide profits where it is a tax resident. In the UAE, you're taxable here if you are a UAE tax resident. For example, you're incorporated in the UAE or your big decisions are made here. Or if you are non-resident but have a permanent or UAE-sourced income. For example, your company has a home. The country that is your company's home can tax its profits. Now, let's see what the rule says. A company is taxed on worldwide profits where it is a tax resident. In the UAE, you are taxable here if you are UAE tax resident. For example, you are incorporated in the UAE or your big decisions are made here. Or if you are non-resident but have a permanent establishment or UAE-sourced income. Also, place of effective management. It's where top decisions are actually made. Treaties use this to break ties if two countries both claim you. And why it matters? If your company is still tax resident in country A, just renting a room in Dubai doesn't move your worldwide profits out of country A. To move taxing rights to the UAE, you usually need a UAE resident company with real management, plus real activity in the UAE. And make sure you're not tax resident somewhere else, under the country rules. Let's do a finger example. You're the owner and sit and decide in London. UK says, I tax worldwide profit. You move board meets, office staff in Dubai, UAE can be the home. If you move just a mailbox in Dubai, nope, it's not enough. The second thing you need to know is that treaties stop double tax, but don't make tax disappear. For example, two parents want the same candy, right? A treaty says which parent takes it, so you don't pay twice. It doesn't make the candy vanish. Let's see what the rule says. The UAE has lots of double tax treaties. Double tax treaties allocate who taxes which income and gives credit or exemptions to avoid double tax. Double tax treaties do not create magic zero tax. Why it matters? Treaties keep you from paying twice, but if income is taxable somewhere, you will still pay somewhere. Let's do a finger example. Country A or country B. Treaty decides. You don't pay both. So, before we move on, take a breather. The next modules go deep into the tax, filings, and banking. It's all crucial, but it can feel like trying to build your company while reading a legal manual at the same time. Instead of forcing generic advice onto your unique idea, tap the link below and book a free strategy call. In that one call, we will map the right company structure for your business model, whether you're launching a SaaS, trading physical goods, or running an agency. Also, we will show how to open a UAE bank account that matches your revenue streams, local sales, global payments, and subscriptions. Also, we will build a tax and compliance path that scales with your next moves, fundraising, hiring, or cross-border expansion. Also, we will flag hidden costs and feature upgrades, extra visas, audits, VAT triggers, so you're never blindsided. Then, we will set everything up for you: company, banking, tax, and filings, custom built for where your business is heading over the next 1 to 3 years. No card, no catch. We are official partners of the free zones, so the service is completely free for you. Hit book a strategy call under the video, and in minutes we will take you from confused to fully registered, with a structure that's designed for where your business is going, not just where it starts. So hit book a strategy call under the video, and in minutes we will take you from confused to fully registered, with a structure that's designed for where your business is going, not just where it starts. The third one, what is UAE corporate tax and why it's still good? Default is 9% tax on profits above 375,000 dirhams. Sometimes free zones can be 0% only if you follow the rules. What the rule says? Standard UAE corporate tax equals 9% on taxable income above 375 dirhams. But very big multinational companies may face global 15% rules. Free zone 0% applies to only qualified income, only if you're qualifying free zone person, which is QFZP, and you keep real substance in the zone, which is people, premises, activity. Also, you keep audited accounts, stay within de minimis limits for non-qualifying income, do qualifying activities, and avoid excluded ones. If you fail at QFZP, you get taxed 9% like others, potentially for a minimum of 5 years before you can actually re-qualify. And why it matters? If you play by free zone rules, you get maybe 0%. If you can't or you don't, your budget would be 9%. Either way, many founders still pay less than in high-tax countries. Let's do a finger example. For example, your profit is million dirhams. First 375,000 dirhams at 0%. Rest maybe 9% if you're not QFZP. QFZP with qualifying income, that qualifying slice can be 0%. The fourth one, will my home country still tax me? If your old company still lives at home, your home country taxes it. even if you open an office in the UAE. If you set up a new UAE company and truly run it from the UAE, then UAE is the home. But watch first your home country CFC rules. Let's see what the rule says. If you want to keep a foreign company tax resident at home country still taxes worldwide profits. UAE office does not change that at all. If you create a new UAE company and make effective management in the UAE, then UAE is a tax resident. Also, home country should not tax its worldwide profits unless your home country CFC rules tax you on the UAE company's profits. Also, CFC differs by country. To prove UAE tax residency for treaty use, companies often get a tax residency certificate, which is TRC. And why it matters? If you structure wrong, your home country still taxes everything. If you structure right, UAE becomes the taxing home. Let's do a finger example. If you get a new UAE company, plus decisions are in Dubai, plus you've got a TRC, then UAE is a home. For example, old UK company stays in UK and run there, then UK taxes worldwide profits. Or another example, if you still live in home country, for example X, they might tax your salary and dividends or apply CFC. The fifth one, substance and basic compliance. I'm seriously telling you, do it for real. Don't pretend the company must be real in the UAE, real people, real place, and real work. Do your basic paperwork. And let's see what the rule says. Many places, including the UAE, historically require economic substance. People, premises, and activity where you claim to be taxed. And UAE economic substance regulations, which is ESR, reflect this idea. Keep books, do filings, which is VAT, CT if needed, audits, renew licenses, and visas. And why it matters? Real substance makes your tax position stick. Clean compliance avoids fines and keeps banks and partners happy. Let's do a finger example. FlexiDesk or office staff management in the UAE, audited accounts, timely filings equals safe and solid.